throw a question right back at you. Do you think that's the new trend? I mean, there's a lot of talk that hedge funds and private equity funds are going to be the ultimate replacement for CMBS. It's going to be more expensive, but it's going to be a new way. You know, Blackstone will go out and raise some huge fund. You guys will go out and raise some huge fund, and that will solve the problem. Do you see that as a solution?
You know, we haven't heard of really anybody doing what we're talking about. We're lucky in that we already have an existing platform that we started a couple of years ago that we can leverage off of to build that. Most people, when you hear they're going to start a debt fund, it's to go out and buy debt. And we think that while that is an interesting opportunity, it's also short-lived. The stuff will clear, and when it's gone, it's pretty much gone. There's not going to be hopefully, a continuing, you know, annual feeding frenzy on what's going to come off from the book. So we really haven't heard a lot of people flowing into that sector of really being an originator, because it is difficult. You have to have people that are on the ground in lots of different markets, that know the markets, that are able to, you know, get in front of owners of real estate to help them, you know, effectuate their business plans. And so it's something that, you know, obviously the big the big investment banks have, you know, they're paring that down. So it'll be interesting to see. I would think that if more people see the opportunity, obviously they will jump in, but we really haven't heard of a lot of other groups stepping up to do that right now.
No, very interesting. And Tim, I know at ING you already sort of have a platform too that does direct lending. Are you guys still active, or are you guys slowing down to see what happens?
We're still active, but it's the lending business is principally focused on Europe, and in fact we do have a sort of CMBS team that has been set up in London to take advantage of the hole that's been left by other organisations. So I think this is an area that Perry's sort of highlighted is an area that perhaps people who've not been engaged in it before will move into, because I don't think the problems of the last sort of 12 months and the next 12 months in RMBS and CMBS, etc., mean that what was a good idea but with flawed implementation is gone away for good. It will take time for it to be something that comes back significantly, but I think it will come back, but it will come back with very careful processes and probably different degrees of regulation than it saw in the past, but it will come back.
Very interesting. Philip, I know you said you guys have a pretty set strategy for taking Bs and turning them to As. Does that change in today's market, or are there still places where you can do that?
Oh, there's still plenty of places you can do it. I think even more so in today's market, because the shift has gone from real estate operating companies to financial companies. What that means is you have a lot of non-real estate companies that acquired real estate that flipped them. In fact, the term of ownership oftentimes was shorter than the term of the lease by the companies that own the office buildings. So they had inherently very little vested in being able to renew tenants. And what drives profitability in the office building business fundamentally is renewing tenants. Renewing tenants keeps generating profits. So you have a fallout of people who operate buildings, and you have an increase in the percentage of ownership by people who are fundamentally just financial companies. The consequence is that the operations of office buildings has declined. And because of that, I think the ability to reposition buildings that might even been A's and have drifted down to B's in operation, and the ability then to take tenants away from those buildings and put them into A's, and the competition over tenants and the satisfaction of tenants in being in buildings, which fundamentally are the people who pay the bills and generate the returns, has declined. So for us, repositioning buildings, as long as they are well located in markets that are premium. It's hard to reposition a building in a suburban market where what you're competing on is price. But when you're talking about premium markets, well-located buildings, repositioning is fundamentally how you add value. It's not in capital structure, and it's not in buying low, although that gives you a huge advantage. It's in performing better. So yeah, we find that opportunity throughout our throughout markets that we're looking at.
Well, and is there any, when you look at GE, is there any set focus going forward that, you know, we think this is the best product type, or is it just balancing your portfolio and trying to get a safe return from a balanced portfolio?
You know, I think our perspective internally is the best product type is the product type that achieves the highest risk-adjusted return. In today's environment, we're sticking with our strategy of office as the type in terms of execution. You know, I think we're quickly marching down the road of office development. We certainly think there are opportunities today, particularly on the large transaction side, where there are a lot of thin bid situations, and you know, there's a general inability for a lot of traditional players to take down the real estate, to write that check, and the financing is terribly inefficient. So, you know, if I were to say that there's something thematically that we're going to be focused on this year from a bias perspective, it's going to be office and taking advantage of sort of the displacement that's occurring right now.
No, very interesting. Sort of a follow-up to something that Perry mentioned, and maybe it's a little bit of a political question, but you know, in the multifamily arena, basically what we've seen happen is out of every other arena, people that were using too much leverage have been punished by the market and not allowed to use that leverage anymore. But in the multifamily market, the federal government is subsidizing those loans and keeping the markets liquid. Is this a good thing or a bad thing? I mean, is it just that they're too slow to react to what's happening in the market, or are they really doing some good in the marketplace? Does anybody have any opinions on? Barry, I'll let you start.
Well, I guess it is what it is. Freddie and Fannie are here to stay, and they have a mandate to provide liquidity to housing, whether that's single-family residential or multifamily. So I guess in the case of keeping, if you want to look at it politically, and keeping that part of the market active, I don't think they're bailing anybody out necessarily. I just think that it just shows that if there was a market for debt in any other sector, you'd see much more robust buying and selling, because as we've all kind of stated, while we think fundamentals are strong or at the worst right now, flat in many of the best markets, you just can't get anything done because there's no debt. And again, with no bid or with no ask, or it's impossible to keep markets functioning. So in one sense, they are keeping a market functioning in terms of buying and selling, but they're not propping up the underlying fundamentals of the multifamily market. That has to, you know, work its way out on its own. Whether or not paying a 6 cap or a 5.5 cap for a multifamily community is the right thing right now, it will remain to be seen based on the fundamentals. The debt is just a tool to help those transactions get done.
Any other opinions on?
Well, I mean, you know, large multifamily developers, many of them escaped the ultimate penalty because they sell their units, and many times they financed off plans. They didn't take the penalty because they sold and they were out. You can't have an anti-foreclosure bill of any sort because you'll never get another loan passed ever. I mean, nobody will make a loan if they think that the ultimate penalty is that they will not be able to foreclose. So you're killing off demand for mortgages. I mean, you can't ever do that. You know, we are caught in the dilemma that in the old days, the originator banks, S&Ls, held the actual paper, and you could track back. You can't do that now. So it's like a little piece of mercury. You can't really pin it down. And I don't think there's a true bailout going on, and it's unfortunate that some greed was in the system as well. And I think, you know, it's one of those situations where you just got to hope to clamp down a little better, and next time we don't have this happen. And it's got to play out in some senses, and it's a mean thing to say, but a recession is the medicine we need. And I don't mean to be callous, because there's a lot of people who lose jobs in recession and pay a terrible price. And it sounds awfully callous, and I don't mean it to sound that way, but that's some of the penalty we're gonna pay, and it's not nice medicine for anybody, particularly those who pay the ultimate price, whether it's because they lose their homes or because they lose their jobs, and that's not right. And brighter minds than mine will come up with a better remedy, but a sweeping broad brush is not the way to deal with this.
Any opinion?